Welcome back, everybody. So today we are going to be talking about markets, economics, and everything else in between. And yes, I am not driving my Lamborghini today. I am driving my Rolls Royce. I mean, all jokes aside, I have been driving a Toyota for the last 15 years. And you might be asking, why am I doing that? It's because of reliability. And also it's cheap. And you know, there's so many of my friends who are in so much debt with cars like Mercedes, BMW, etc. They've got all on lease to look a specific way. And even though I could afford these cars, I much prefer driving this car, and I really enjoy it. Like I've had it for like 15 years, and anyway, I'm kind of digressing. But let's talk about some main topics. What is the SP 500 and NASDAQ? So the consensus over the last couple of months, I've been talking about this probably 2 or 3 months ago, is that typically, historically, the consensus is that the market typically goes down in September. It's normally a bad month historically. To get this completely correct, September the 3rd has historically marked the monthly high for the S&P 500 since 1928. So there's a lot of historical data what basically advocates for the market to go down in September. And what I find very, very interesting about this is that everybody's talking about it. And because everybody is talking about it, it's making me think very differently in terms of what potentially could be happening. But what I find very fascinating is what happens if it doesn't? So let's say a lot of people sell, let's say at the start of September, for the anticipation that the market is going to go down. And the market just basically just keeps on blasting through. What I'm trying to, let's say, articulate is how behavior could potentially change if the market does not necessarily go down. So let's say we are anticipating a lot of rate cuts. I mean, that is the narrative. The narrative is we're anticipating a lot of rate cuts. We are going to see a lot of volatility in September, and normally the market goes down in September. But let's just say the market just keeps on going up, and a lot of people are basically sat on cash and they don't really know when to get back into the market because they were expecting, obviously, the market to go down. So that is just something to be aware of. Now, also on the other side, let's say a lot of people basically sell in September, to the start of September. We see a lot of pressure to the downside, and then obviously they want to get back into these positions throughout September to obviously, because normally the narrative after September is you have something called a Santa rally, something along the lines of obviously everyone feels good towards Christmas. So, you know, everybody is feeling really, really good for the new year, etc., etc. So the overall view is that the market is going to rally into the year end. And what happens if the market just keeps on going down? Because everybody would have a position to go long. And majority of retail traders or retail investors do not necessarily do anything in regards to hedging. Now, again, I just find this very, very interesting because this is the consensus. The consensus is market goes down in September, and obviously buy the dip and we'll be fine into the year end. Now, I'm just kind of thinking about this a little bit more just in terms of what happens if that does not necessarily happen. Would you want to have some downside protection or some, let's say, upside protection as well? And what could you be doing from a leverage perspective to get you a good risk-adjusted return? And this is the thing from a retail perspective. This is what I wanted to kind of touch on. And this is something what I've been getting a lot of comments about over the past couple of weeks and months. And this is just in relation to my anticipation of the market going down to obviously bring the yields down on the long end of the bond market. This is 10, 20, 30-year money. And the whole executive summary of all of this is basically the United States has about $37 trillion, $38 trillion of debt, of which 40% of that debt needs to roll over onto new rates. These rates are typically around 4 to 4.5%, or let's say touching nearly 5%. If the debt gets rolled over onto these new rates, the interest payments on that debt cannot necessarily get paid by the United States government because they do not generate enough tax revenue to basically pay the interest on that debt. And we also have other different types of dynamics going on with Trump and everything else, what I will touch on. But basically, what I want to talk about is that I was quite vocal about the reason why I believe that the stock market would go down. And, you know, I was pretty much incorrect on that. And what I want to touch on is the importance of hedging. And this is just in case that you are completely incorrect. So obviously I was incorrect. I did pretty well on some short-term trades, short in gold, etc. and also on some, I was very highly leveraged NDX, 3x leveraged NDX. I don't really talk about positions as well because I don't want anybody to copy me. I don't want to be justifying positions when I've got these positions open. But basically, that did relatively okay. But obviously, I started to lose money on it, and I started to close that position as the market basically started to tick back up. But I also had other positions on what would obviously benefit if the market started to go up again. So you want to be hedging out your risk. So what I am getting at is that it's not an all or nothing thing. You don't necessarily need to be all in long, all in short. You can basically have a blended approach from a short perspective and also from a long perspective. The term is called a Sharpe ratio. You can basically plug your portfolio into these views. It basically looks at the risk adjusted return in terms of anticipated, let's say, volatility. We're not going to get into the risk-adjusted return on Sharpe ratios here, but basically, I just wanted to reiterate that you want to be hedging out some of your risk in case the market goes against you. So basically, that is where we are from a stock market perspective. Also, what I want to reiterate as well is how the SP 500 and NASDAQ have basically been respecting these trend lines since 1998. Pretty much, I'll put that on the screen now. You can basically see that we are coming up to an area of resistance again. And, you know, I would kind of anticipate some more volatility to the downside. But like I'm saying, I just find it very fascinating is that at the moment, the narrative is that September is typically a bad month. And what happens if it's not a bad month? And obviously the amount of people who will be positioning for a bad month, you know, it kind of makes me want to take the contrarian, the contrarian view on it and go aggressively long. But again, I mean, I'm just putting my thoughts out there. Something else what I want to just touch on is that I've been a little bit quiet on YouTube over summer. I'm meeting up with a lot of family and friends. I haven't seen a lot of people in quite a long time. So I am obviously meeting a lot of, I won't say family members, but I spend a lot of time with my granddad. So I enjoy spending time with my granddad. So any free time I've basically been spending with him. I've been showing him about what I'm doing on obviously YouTube, on Instagram, and it's been really good. Typically, summer is quite flat historically anyway. For the stock markets, I mean, there's not really much going on because a lot of people typically fly into Lake Como, Italy, or they're going to, you know what I mean, but basically they're on vacation, right? So there's not really much going on. Obviously, as people start to come back from vacation into September, obviously that is where you can start to have a lot of rebalancing, etc. And obviously when you can start to see a lot of this volatility or the expectation of volatility in September. So that is the reason. So that's the reason why I've been a little bit quiet, is because I've been spending a lot of time with my granddad, and I've been spending a lot of time on the businesses what I run in the United Kingdom. I'm quite fortunate that I have a lot of access to a lot of, let's say, advertising data from a Facebook perspective, from a Google perspective, and YouTube perspective as well. And it is a very mixed bag in the United Kingdom. So there's a lot of clients who I'm specifically talking to. I speak to a lot of different businesses in different types of sectors around the United Kingdom, and there's some businesses who are doing exceptionally well. The common trend with these businesses is that roughly at least 20% of their revenue is from the government. And I find that quite fascinating, because what I also find fascinating is just the revenue from, let's say, the public sector could be a lot more profitable than private sector work. And that seems to be a trend. So normally the companies who are, let's say, booming, I would ask them in terms of how good that work is from the, obviously, public sector. And they say it is very good, very attractive. And the reason why I find it very fascinating, is because of the pricing dynamics on public to private sector work. And the companies who are not doing that well are private sector. Majority of their work is private sector. They're in, again, different types of industries, but they seem to be suffering from a tax policy, national insurance, business rates, basically everything what you can kind of imagine, really. What I find so wild is just how business rates are a massive thing here in the UK. Again, if you're from the United States, or you're from Canada, or from wherever, basically if you have a shop, let's say a storefront or whatever, you would have to pay business rates on that storefront. So you'd have to pay the rent, obviously, for the building, and then you would have to pay the local council to operate your business out of there. And this can be very, very expensive. This can be at least £1,500 or £2,000 a month. And obviously, you can probably imagine if you are selling coffees, you'd have to sell a lot of coffees, plus wages, plus insurance, plus everything else. So it's very, very, very expensive. There's a lot of charity shops. There's a lot of bookies, meaning gambling, a lot of vape shops, hairdressers, etc. But there's not really any other businesses outside of that, really. So I don't really know if they get preferential rates on business rates, but yeah, some of these businesses, I don't really understand how they operate in the United Kingdom, specifically around business rates, obviously rent, insurance, staffing, etc. But that is just something what I thought I would share because I found it very, very interesting. Something else as well, what I have been doing, what I found very fascinating. Again, I'm going to do this in the United States as well. But what I've been doing as I've been obviously traveling around the United Kingdom, meeting up with different clients and seeing different people, is I have been looking at the demographics of different types of councils in the entire United Kingdom. And I've been looking at different types of postcodes and different types of demographics in these specific postcodes. And I've been looking at the household income of them postcodes, plus the demographic, plus which way them postcodes are kind of leaning from a political standpoint. So are they more Labour? Are they more Conservative? Are they more whatever? And the reason why I find it very, very fascinating is because there's a large correlation between the postcodes what have very low household income and they have quite high levels of unemployment. They are all typically voting for Labour or let's say for Democrats or whatever. And obviously the postcodes what are quite rich or quite affluent from a household income perspective, obviously from an employment perspective as well, they are typically all voting Conservative. Now, this might not necessarily be a surprise, but what I find fascinating is that if you could influence these postcodes based on advertising or based on specific types of targeting to specific types of demographics, and you can kind of make sure that they are more dependent on the state, you could basically influence more votes, because as you can probably imagine, if you become more and more dependent on the state, you are only going to vote one way, what is typically Labour or Democrat. And I just find it very fascinating, specifically when we start to look at different types of technology systems like TikTok, obviously who owns TikTok from a Instagram perspective, YouTube perspective, etc. Who has access to these platforms? I mean, obviously you got China and the United States, and how you can basically influence policy, and you can also influence how people think in these specific postcodes to vote a specific way. So I just found it very, very, very fascinating when I did this analysis. I might share some of the data. I'm not going to get into the data on here because some of the data what I was looking at is how do I kind of explain it? It's quite controversial. Not necessarily controversial. I don't want to be talking about certain demographics what are dependent on the state, because again, that could kind of upset quite a lot of people because the data is not necessarily aligning with certain viewpoints. And this is another thing as well, specifically on data as well, is that the data what I've been looking at is only as accurate as what I am being presented with. So some of the data from these councils, they typically do annual reports in terms of household income, demographics, unemployment rates of them specific areas. Obviously, there's about 400 councils in the United Kingdom. I pulled all that data into one, basically one database, and then I did a lot of analysis on it, and I was basically just going over it. And when you start to dig into it, it becomes quite apparent of why I think we are where we are from a monetary perspective, from a policy perspective, and everything else. And I'm going to be doing the same in the United States, just to kind of get a good and rough idea. But again, I mean, it's all dependent on the accuracy of the data and also access to the data as well. But I just found that very, very fascinating. The labour market is quite poor in the United Kingdom. So we have a lot of wage stagnation. And what I mean by that is that the United Kingdom has a lot of large service-based sectors. Now, what I mean by wage stagnation or wage compression is that because we have a very heavy service-based economy, now a lot of these sectors are under pressure as a result of AI, right? So the cost of doing things is basically falling dramatically. We've also recently just had the inflation numbers, what have basically come out today. What, again, is not really looking good. I mean, it's kind of being branded as unexpected. There's nothing unexpected about it. I mean, if you follow economics and you understand monetary policy and fiscal policy, it does not look good with what the United Kingdom is basically doing. And something what I've been a big advocate of is the only thing what makes the government accountable is the bond market. So sending bonds to 6% plus would have large implications in terms of financing for the UK government. It'd be incredibly, incredibly painful. And I think that's the only way how we get out of it, is because you need the pain and you need the reflection for progress. I mean, this is something what Ray Dalio talks heavily about. I have been reading Ray Dalio's book. I think it's called Debt Problems or Debt Cycles, or it's his new book. I'll put it on the screen. But I probably read this book 3 times. He talks a lot about a beautiful deleveraging event, what is basically monetizing the debt. And there's different ways of how you can basically do it. And I think some of the solutions what he kind of talks about are quite fascinating. And yeah, I think there'll be a lot of opportunities in the bond market eventually. It's just when does that happen, right? So these are just some things what I have been thinking about. Also in relation to the Fed, what a lot of people want my commentary on. From a Fed perspective, again, what is the narrative? What is the consensus? The consensus is Trump wants the Fed to cut interest rates. The Fed is supposed to be independent, so it cannot necessarily be doing what the administration, what Trump is basically advocating for. I think Trump is very aware of this. And what I also find very fascinating is why would you be saying it? And let me just kind of give you a completely different viewpoint on it. I think Trump is basically saying that we need to fire the Fed, or the Fed basically needs to cut rates, not necessarily because he has any influence. It's because of what he could say after he said it. And what I mean by that is that you can say, we need to fire the Fed, we need to cut interest rates. You have no control over interest rates, and you have no control over the Fed chair. So if anything happens in the economy, what can you do? You can basically say, I told everybody that we needed to cut interest rates, and we didn't cut interest rates, and this is the reason why the Fed is the problem. It's nothing to do with me. It's literally nothing to do with me. It's to do with the Fed. And let's just say he did replace the Fed. You also have a lot of other things what come into question. What is the independence of the Fed? So that would be obviously one point. You also have, if he does replace him with somebody, and the economy does, let's say, start to tank, that does not necessarily look good, because you are basically blamed for it. I think he is playing a certain level of chess, because he is very much aware that he cannot necessarily fire him. And obviously, if the economy massively tanks, you can basically say, well, the reason for that is because of the Fed chair. It's nothing to do with me, blah, 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 blah. And I think this is what is playing out. Now, in relation to geopolitics, and obviously macroeconomics, just in relation to China, I am still seeing a significant amount of stress in China. From a banking perspective, from a finance perspective, I'm seeing a lot of pressure in Asia as well. And obviously having rates elevated puts a lot of squeeze on these economies, specifically in Asia, obviously in Europe as well. And I think it's very, very intentional, because you basically want to cripple these economies because they are more aligned with China than the United States. This is just my opinion. So you are basically advocating for these economies to feel the squeeze. And as they start to feel the squeeze, it's like an elastic band. I'm anticipating some type of snap. And when that snap happens, I'm expecting the bond market to be a very, very, very good place to invest. Now, this would normally be categorized as a liquidity crisis. I'll put the definition on the screen. And this is typically when all assets basically get sold off and people go back to the dollar. Think of it like this. You're playing musical chairs, the music stops, and you basically, you're trying to park your money somewhere what does not necessarily lose its value. Now, obviously, during a liquidity crisis, they would typically print money. And, you just want to be putting your money somewhere where, you are going to get a return. And normally what they do is that they print the money and then they buy the long end of the bond market. And this would be a great opportunity, in my opinion, to basically buy the long end of the bond market, because you would make a significant return, obviously, when something like that does happen. But again, I mean, a liquidity crisis doesn't really happen often. If you looked at 2008, and this is something what I've been doing over the last 2 weeks, I was looking at 2008, I was looking at 2000, just in relation to different types of assets and how they basically all correlated together. So obviously people probably anticipate that when 2008 was happening, that gold basically rallied. That was correct, but it massively got sold off because, again, as you have a lot of, let's say, liabilities to pay or obligations to pay, you basically have to sell your assets to basically cover them obligations. So even if you do think that gold is going to keep going up, if you are forced to liquidate, it doesn't really matter. You have to liquidate anyway. So you would be selling gold, whatever, to basically pay down your liabilities, and you have a complete debt restructuring. So that is kind of how I'm seeing things. Obviously, we have a lot of dynamics with Eastern Europe. We have a lot of dynamics, obviously, in the Middle East. A lot of the things what I was talking about in the past couple of months, just in relation to Pakistan and India, that seems to have calmed down. But again, that has calmed down because China is on this 90-day pause. Obviously, that is coming up for, let's say, renewal or to be assessing the tariffs with China. And this is what I was kind of reiterating in my previous videos about looking at the entire stack of the United States against China and what types of assets do they hold and how you can basically influence policy, how you can basically influence how people think. Now, when China was under a lot of stress, we basically saw an escalation, what basically happened overnight in Pakistan and India. And I don't think this is a coincidence. I mean, Pakistan has a large, very, 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 very large user base of TikTok. Now, it's very much the same the other way around. In India, you have a large amount of users who are using Instagram, and TikTok is banned in India. And again, just look at who controls these platforms and how you can basically influence things, obviously, in these areas of the world. Because obviously, because if you are China, you know that the United States cannot get into another war because they are not in the best financial situation, specifically when they have a lot of debt to roll over and they have a lot of financing issues, they have a revenue problem, etc. They are already in Eastern Europe, the Middle East. They cannot be fighting another war in India and Pakistan. So I think that is the reason why we saw a tariff pause. And obviously we saw let's say, a ceasefire agreement between India and Pakistan. And yeah, I just want to really reiterate as well that I do think that Scott Bensant has a very, very, very good understanding of currencies, macroeconomics. His background is very, very, very impressive when it comes to these type of events, specifically on currencies and the bond markets. So to think that the administration does not necessarily understand what is going on, I think is very, very naive. But anyway, that is just how I am currently thinking about markets. There's also some other topics what I've been kind of talking about with a few people on Instagram. What is in relation to semiconductors and obviously what is going on in that sector. I think that kind of needs its own video. Also as well, in relation to a lot of direct messages what I've been getting, specifically on the Bitcoin side of things. I did a story, I know I kind of annoyed a lot of people. I lost over 6,000 followers in the space of about 2 days. What was very aggressive, I know, but again, I was talking a lot about Bitcoin, and obviously if you don't hold any Bitcoin, if you don't have any interest in understanding what Bitcoin is, I can understand that it would be a little bit overwhelming, me talking about Bitcoin for 70 stories. But basically, there's a lot of misunderstanding about what Bitcoin is, and I just want to reiterate that understanding Bitcoin, I think, is vitally, vitally important. And it doesn't necessarily matter where you actually stand on it. What is very important, I think, is just having a good understanding of it. Because Bitcoin ultimately is everything what people don't know about money and everything what they don't know about computers mixed together. And it is very complex and very difficult to understand initially because you are looking at it from a broken system, meaning the United States dollar, British pound, euro, Canadian dollar, pesos, whatever. And when you start to look at things from a Bitcoin lens, things look a lot more calmer rather than quite volatile, because you are looking at things priced in your currency, and obviously the nominal value does not necessarily change. If you've got £10,000 in your bank account or $10,000 in your bank account, you don't necessarily see the $10,000 or pounds go up and down on a daily basis, because you are denominating your entire let's say, operations in that currency. Whereas when you start to operate on a Bitcoin perspective and you start to look at things in Bitcoin or in Satoshis, you have a completely different perspective on how the world is currently operating, and you do not necessarily see the volatility that much. And I'm probably going to do a bit more of a deeper dive video just on understanding Bitcoin a little bit more, because I didn't really anticipate that there were so many people who I was talking to who did not really have much depth in relation to obviously understanding how the Bitcoin network works, obviously understanding how Bitcoin can be very, very, very beneficial for personal sovereignty, and it can basically help solve a lot of the fiscal problems in the world. And this is another thing as well. I just want to kind of touch on this again. I mean, I know it's a long video, right? But I do think that you could have Bitcoin, what would solve a lot of the problems in the world. And I don't mean that in a hippie kind of way or anything like that. Basically, what I'm getting at is that if a country is going to go to war with another country, there is an incentive to do so, because war is incredibly, incredibly profitable, because you basically print the money. Whereas before, prior to, let's say, 1971 or whatever, if you wanted to go to war and you were on a hard money standard, gold, whatever, you had to raise money, tax revenue, to basically fund the war. So you would raise it through taxes, and basically the, let's say, nation would agree to go to war. Whereas today, you don't necessarily need the consensus of the entire population. You can basically say, yes, we are going to war. Yes, we're going to send money to Ukraine. Yes, we're going to do A, B, C, X, Y, and Z. And there is no accountability of that spending. You see the spending in the inflation and the currency debasement, but you as an individual, you cannot necessarily opt out. You cannot necessarily opt out from it. So if, for example, your country was going to send $100 billion or £100 billion to Ukraine, for example, back in the day, you would need to have a vote on that. Whereas today, there's no vote required, and you basically just print the money, and all that money basically goes to contractors, and where else does it go? I mean, again, we are kind of speculating, but basically what I am getting at is, on a hard money standard, on a Bitcoin denominated standard, or a Bitcoin world, or a gold-backed denominated world, you would not necessarily see that much war, because if you was going to go to war, you are risking your reserves. You are financing things through your reserves, through your commodities, and through your assets like Bitcoin, gold, whatever. So again, I think it's very, very, a very, very interesting tool of how you could potentially advocate for more peace through a Bitcoin denominated world, rather than on a fiat standard, because the incentives are misaligned. And this is, again, I've been talking a lot about this on DC Economics on the Instagram page, just in relation to the incentives. When you look at the incentives, from a tax perspective, monetary perspective, policy perspective, you can basically understand the reasons why everything is basically messed up. And this is the reason why I was doing a lot of this analysis on postcodes and demographics in the United Kingdom and everything like that, because I'm trying to understand the incentives of why people vote specific ways and why would they be doing that. And a lot of it is to do with, again, if you are very, very dependent on the system, you are going to be advocating for more of the same, basically. So I can kind of understand how and why you would want to change the demographic structures of specific postcodes, because then you could have a large influence from a political standpoint. But anyway, hopefully this video has not been too long. These are just some ideas of what I've been thinking about. Obviously, September is going to be very interesting, right? And obviously, understanding what the Fed is going to be doing, etc. The reason why I've been quiet, like I was saying to you before, is because of my granddad. I've been spending a lot of time with my granddad. And this is another thing, right? It's like markets and making money is important, but the biggest thing, what you have, is your time. Your time is your most valuable asset and currency. And you are basically trading something what is very, very finite in supply. What is your time for something what they can basically print? And for me, I want to spend a lot more time with my granddad. And, that is something what I'm consciously doing. I am not making as much money as a result of spending time with my granddad, but I know that it's time well spent, and that is something what I want to do. And obviously, me being in the UK, that's something what I want to be doing a lot more of. But again, I will be doing more YouTube videos. At the moment, I am just finding it a little bit difficult due to my business commitments and a few other things what I've got going on in the UK. Obviously, if you have any questions or anything like that, please leave it in the comment section down below. Please make sure that you like, comment, and subscribe. I should have really said that at the start of the video. But anyway, to the 4 people who keep on supporting me, hope you're having a lovely day, and take care. Bye-bye.